Hello, and welcome to the very first episode of Not Financial Advice, where I give you advice that, of course, is not financial. So today we're going to be talking about getting started with stocks. How do you get started? Most people think it's scary and really hard and complicated and risky, and I'm going to show you in this video that it's not scary at all. It's not really that hard, and it's definitely not risky if you know the rules to the game, because investing is a game. And if you know the rules on how to play the game, you're going to do a lot better than if you don't. So, with that said, there's three main rules that I think are important and that I also personally follow. And that's knowing the difference between long and short-term capital gains, dollar cost averaging into any investment that you get, and also averaging out of it, and keeping a portfolio and managing this portfolio. So, number one, long versus short term. What is it? Long term is anything you hold for more than a year. So any asset that you buy, you've held for more than a year before you sell it. And short term is any asset that you buy that you don't hold for a year and then you sell it. Why is this important? Well, if you scroll down, and I'll link all of these pages in the description, you'll see that long-term capital gains, the max you can pay is 20%. So if you hold for more than a year, the max you can pay is 20% plus whatever your state taxes are. Where if you go to short-term, the max you can pay is 37% plus your state taxes. So you can go into the details of how all of this is calculated. Your regular income is included in this, and it's a little more complicated than what I just explained. But long story short, if you hold for more than a year, you will pay less taxes. So hold everything you buy for more than a year. Rule number one. Rule number two, dollar cost average into things and do the same thing in reverse. So average in and average out. And why is that important? Well, instead of trying to time the market, which is almost impossible, waiting for a low or a high, because you never know if we're really at a low or at a high, you just average in to get the average low, and then you average out to get the average high. Like in this example, this guy put in $50 a day. The price of the stock fluctuated, and he ended with an average price of all the fluctuations somewhere in the middle. And you can do this with any broker out there, whether you're using Robinhood, Webull, whatever you're using. Any of the brokers will allow you to set up a daily automatic buy or some kind of consecutive buy. You can do it every day. You can do it every week. You can change the increment that you buy every day. You can do $5, $10 a day, $20 a day. You can do multiple stocks for different amounts every day, every week. You set the parameters, but the point is average in and average out. And that's important because if you look at any chart, if the market starts to go down, instead of waiting to buy the very bottom, which is almost impossible to predict and buy at, you just start buying every single day as it goes down, including on the way back up. And then by the time you're here, your buy average is going to be, somewhere here. So instead of putting all of your money in at once right here, or trying to time it and doing it here, you take however much money you want and just divide it up and start buying every day or every week, depending on your timeline and how much money you want to put in. Now, this doesn't mean that you can't buy bulk at any time, but in this same example, you can start buying every day, and maybe if you see the market really start tanking, you can take a chunk of cash and buy a large amount of it and keep your daily buys going. Or maybe you just increase the amount that you're buying daily. Instead of $10 a day, maybe you're doing $100 a day when it's super low, or $1,000 a day for a crazy dip or something. But you can take advantage of those dips, and you're not just locking in one price by putting in all of your money at once. You're averaging in, and when you see opportunities, you buy some. Then you can do the same thing in reverse. When the market really starts rallying, you can just start selling $10 a day, and maybe if it starts spiking, you change that to $100 a day, or you sell a large percentage of your portfolio, or $1,000 a day, and you can do the same thing in reverse. So dollar cost averaging. Lastly, so rule number 3, keep and manage a portfolio. So this can be whatever you want. Here I have 20% stocks, 20% gold and silver, 20% crypto, 20% real estate, 20% cash. So however much money you have, you divide it up into these percentages. So if you have $1,000, you put $200 into each one of these. You have $10,000, you got $2,000 into each one of these, right? And if you're just getting started, you can take your $10,000 and set up daily buys that are even in these same percentages to all the different stocks or crypto you want to get into, and average in and maintain your portfolio at the same time. So now you're diversifying and you're averaging in at the same time. And eventually, you're going to start seeing fluctuations in the market once you've averaged in for a long time. So say your crypto goes up a lot in price and it goes to 80% of your portfolio. Well, then you chop off 60% of that and you put it back into the rest of your portfolio and even it back out. Maybe some of these have gone down. Those would be the first ones to prop back up to 20%. And so on. And you're always managing these percentages and trimming what has grown and adding into what has gone down. So those are the 3 major rules. Now let's get into some stocks to start averaging into. So the biggest one that I would look at is SPY, ticker symbol. Every stock has a little ticker symbol you can search, but this is Standard & Poor's top 500 stocks in the entire market, and it's an exchange-traded fund. And what is that? Well, that's a fund of money that gets invested into the top 500 stocks. And this fund is just one stock that you can buy on the market that some team is Standard & Poor's, manages. And by buying one share of this stock or putting money into this stock, you're getting exposure to all of the companies that they then take all that money from investors and invest it into a bunch of different companies for you and manage a portfolio. So by buying this one stock, you're basically buying a portfolio that's managed by Standard & Poor's. This is what your 401k, your retirement funds, most of them are all ETFs like this. And why I chose this one is because this is the oldest and the biggest ETF there is. It's been around since 1993. It's got the most money invested into it out of any ETF, and it's the oldest. So it's the tried and true oldest with the most money into it. So this is a great one to start averaging into. We're starting to go down again, so it looks like it's a good time to just set up daily buys. So before we dive into some other stocks here, there's 2 main ways that stocks make you money, or any investment makes you money, really. It either grows in value so you can sell it later for profit, or it pays you out incrementally. The stocks that grow in value are known as growth stocks. The stocks that pay you out are known as dividend stocks. They give you a dividend of their profits, basically, right? So in this case, this is a fund that owns a bunch of different stocks. So this actually pays you a dividend of 1.28%. And it also grows over time. So on average, it usually grows about 7% per year, I think, something like that. But in general, it's going to grow, and it's also going to pay you out, a pretty decent dividend, but not as high as dividend stocks themselves. But then you can dive a little deeper and get into some other stocks. Like this is another one from Standard & Poor's, which is the top 500 high dividend stocks. And it's a fund that just holds a bunch of stocks that pay out dividends, right? It's another fund that you can just buy one stock, get exposure to a bunch of dividend stocks, and get a dividend for it. And this pays out 4.45%. But it's not going to grow like the SPY does, right? Like this max chart is pretty much just steady. So, you can put a bunch of money into this and you'll get 5% yield on that money that you have in there. So, dividend stocks. And with that said, the next one on the list here is SPYG, which is Standard & Poor's growth ETF. So these are all stocks designed to just grow in value, which this one happens to mirror SPY pretty well. But the yield is even lower because it's focused only on the growth ones. And yeah, this is another good one to get into. Another portfolio that holds a bunch of single stocks. So you're getting exposure to the entire market by buying these. You know, when you go back to S&P 500 ETF, the SPY, you know, this isn't risky if you know what this is, because this is our entire market. This is our top 500 stocks. If you lose everything and this goes to zero, our entire economy has collapsed and you have bigger things to worry about. It doesn't matter where your money was at that point, because there's economic collapse. Because if one of these goes down, say even Apple goes down to 0%, you've only lost 5.63% of the portfolio, and then they're probably going to take other stocks that are up and buy more of that, because they're managing the portfolio just like you do in your own portfolio. So in order for this thing to go to zero, all of these companies at the same time have to go to zero, which is, you know, only possible if the entire country collapses, I guess. So it's pretty safe to say that's not going to happen. It's a pretty good spot to put your money to just grow over time. And this is what your 401ks and all your retirement funds and all of those things are buying. This is what you're paying some manager to buy for you, which is then managed by a bunch of other people, and hence why you should just do this by yourself. So those are ETFs. Then you can get into individual stocks, which if you want to, you can also just go here and see what these ETFs are holding, and that'll start to give you a good idea of some pretty good stocks to buy. You know, if you want dividends or growth, you can start buying these individual stocks. But I tend to stick to the ETFs to give me exposure to, you know, a wide range of stocks. And then I buy some gold, which is the next one on the list. GLD. This is another stock from Standard Emporium, but instead of an ETF, this is actually a trust. So this trust holds gold bars in vaults, basically. So by buying this stock, you're buying gold. And if you look at the chart of this, it follows the price of gold. It mirrors the price of gold. So by buying this stock, you're getting exposure to gold. Is a physical silver trust that mirrors the price of silver. If you look at the all-time chart, iShares is owned by BlackRock, if you're not familiar. But this is a physical silver trust that holds physical silver in vaults in London. So by buying this, you're getting exposure to silver. Last but not least in the stock portfolio is some real estate exposure. So of course you could buy a house or some actual real estate, and that would be part of your portfolio. Or you can also buy a stock that mirrors real estate and pays out a dividend from the rents that this fund owns. So this is a fund that holds a bunch of real estate, and then they sell the stock to investors who can, you know, pool their money in. So when you buy this stock, they're then going to take that money, invest it in real estate, and then they give you a piece of, you know, their rent, basically, because they're using your money to buy the stuff. So this gives you exposure to the real estate market in general, and you get a dividend from that as well that pays you out. Last but certainly not least is crypto. So you can also average into any of these. They do trade 7 days a week instead of 5, so you have to change your numbers a little bit for that to even out in your percentages when creating a portfolio. But, you know, here you can put 20% into the entire crypto market and buy a bunch of different tokens and coins in the crypto market. And of course, within this, you're going to have a portfolio within a portfolio. If we go back to our pie chart, you have 20% in crypto, but then this crypto holding could also be an entirely different portfolio of crypto holdings. So you could have, you know, 50% Bitcoin, 25% Ethereum, and then 25% everything else is, you know, a pretty good example of that. So those are the 3 major rules. Long term, hold everything long term, dollar cost average into everything and average out of everything. Always keep a maintained portfolio, and start exploring some different stocks you can get into, which I gave you some pretty good ones to start with that are, really solid. This will build a really strong portfolio because you're diversifying with all of this. With the ETFs, you're getting exposure to the entire stock market. You're holding all of these different companies. You're holding all the best growth stocks. You're holding all the best dividend stocks. You're accumulating some physical gold. You're accumulating physical silver. And you're accumulating some real estate and also getting paid out for that. And then, you can start accumulating some crypto as well. And if you dive into crypto as well, there's the same thing. There's growth coins, like Bitcoin would be like a growth coin. The only way you make money off of it is if it goes up in value. Some of these basically pay dividends as well. You can stake them, which is a whole other topic, but they pay you out in percentages just like dividend stocks would. So you can build an entire portfolio in this as well. So that's all I got for today. That's the start of investing. What I would suggest as a starting, way to get into this is to open up a broker and set up a daily buy of, $5 a day into each one of these. And you can just start averaging in. And by doing that, you're averaging in and you're diversifying your portfolio. And then you can hold everything long term. You can start selling once you've held for more than a year. And then if you see big dips, you can up your daily buys on certain things or buy a huge chunk. And then, when we get into market highs and you're in profit a lot, you can start averaging out of those things back into cash, rebalance the portfolio, and then do the same thing all over again. And this is the game, guys. So with that said, that's all I got. Until next time, peace out and good luck.